Yes, I mean, I think low on conviction is the first thing to think about with regards to the short-term path of inflation. Only the fools are confident, surely. We've seen enough surprises in the last few years, and in the last few months in particular. I think the thing that people, if you look at the last month in particular, there's been something for the bulls and the bears here. As we've long talked about, you and everyone in the industry sort of are understanding that there are some pretty big forces pulling U.S. inflation particularly down over coming quarters. But the thing that's still got people worrying a little bit is that shelter inflation still seems to be, potentially going up further to go. And, you've had three different wage data points in the last few weeks, which have got enough to sort of, put the cat amongst the pigeons a little bit. So conviction should be low. That's really how we're positioned at the moment. The Federal Reserve has still got a long way before it can feel relaxed enough to pivot to that softer position, that, that return to nurture mode that everyone seems to be looking for, understandably so intently, and trying to position for.
As you talk about what you call a muscular response from central banks, some strong-arm tactics here to tackle inflation, what does that mean in terms of some of the positioning? Because it feels as though investors have been cautious so far this year. There's been a little bit more buying in recent weeks. But should the positioning stay very much on the sidelines at this point, or be actively selling into the rally?
Yes, it's a great question, isn't it? Because you have seen in the last month, like you say, that it feels like those looking for evidence of a soft landing feel that they have sort of found enough evidence that there is that chance that those probabilities have widened a little bit. That's not necessarily how we would see it, I have to say, at the moment. There are paths to a soft landing. The economy, it's welcome that it's sort of, the sort of many of the data points are still suggesting that the US consumer remains in a pretty good fettle. But we would argue actually that there's a long way to go in this slowdown, and that stocks are, that investors may be risking being a little bit premature. The other thing to think about here, I think, which is an interesting aside, is, I do feel, we all know this, that, investors feel very comfortable in amongst a trend, don't they? And actually, many are looking for that, in muscle memory terms, a return to that pre-2020, 2019 kind of macroeconomic tram lines where disinflation, never lower real interest rates, those kind of things. And therefore that's, you're looking for some of those, secular growth stocks. They know what does well, or feel they know what does well in that environment. So people are looking very much for that sort of return to that macro environment. We wouldn't be confident on that at all. That the world does look different. We have changed. We have been changed a little bit. Us as consumers and individuals and businesses have changed over the last couple of years by the pandemic and the various other forces that have been exogenous forces that have been bludgeoning us and shaping us. We don't know to the extent how we've changed, and I think that should give you some reticence with regards to convictions about that sort of that medium-term outlook. For us, we're still pretty positive on the sort of that we feel that long-term investors, you're in the interregnum between the ICT revolution and the artificial intelligence revolution. You've got to stay invested and have stock exposure to be able to participate and scoop up the rewards of those that incoming industrial revolution and transformation. But the short-term outlook is sticky and tricky, and we are, as a result, long duration and shorter stocks than we were a month ago. And we have a long DM equity versus EM equity trade, which again is a slowdown trade.